And I always like to cover what I saw happening as a summary for this week in the stock market. Obviously, one of the things that's very important about retirement is, how your investments are doing. It's been a tough year altogether. But what I want to cover today, I'm not going to use all the charts I normally use because I want to cover kind of some subjects that I think are interesting and maybe try to keep this as simple as possible. But what's happening right now is you really kind of have two main camps in the stock market. One that believes that the bottom that we hit back in the middle of June is the ultimate bottom, that we are going to rally up from here and eventually hit some new highs and those type of things. And that's the group that's kind of in charge right now. So we've had this nice run up from that bottom point, including this week. And then there's another group that feels that the bottom has not been achieved yet. That we're still going to fall farther, and so they each have their argument. So let me just kind of discuss what each group is looking at and kind of give you some of my opinions on what I'm seeing happening here. So the group that feels that we've already hit the bottom really is looking at the projections for where the Fed funds will go. So the Fed has said in their statement of economic projections that they think they're going to get to 3.8% sometime next year and maybe start lowering rates towards the end of next year. The market believes that they're only going to 3.5% and will actually start lowering rates in February. So think about that. And so the reason the market would be going up so much like it is right now is because if they do start lowering rates in February, that's usually a good thing for the stock market. And the market does look forward, and we're starting to run. And we're having a really heavy run right now with a lot of stocks doing quite well. But if you think about what it will take to get to that path, I believe that path is narrower, still possible. But what would have to happen is kind of one of two situations that I can think of. Number one is inflation would have to fall a lot faster than people expect. So the increases that the Fed has already done to rates would have more impact than it's having now, and we'd see interest rates fall, and then the Fed would start to be able to lower rates to kind of support the slowing economy by February. Okay, so that's one scenario. The second scenario is just that maybe the Federal Reserve kind of chickens out. They continue to raise rates, but the economy starts to soften more than they would expect, and especially because the Fed has a dual mandate of full employment plus low inflation, and maybe unemployment starts to really get higher and higher, and they feel like, hey, even though inflation's at 4% instead of 9% where it is now, we're still going to go ahead and cut rates and those types. So those are kind of the two scenarios. Both are kind of narrow paths just because of the fact that a lot of the inflationary pressure is really coming from outside forces that the Federal Reserve is going to have a hard time dealing with. And this is one of the biggest concerns. And what happens is, so the price of oil and natural gas and things that are kind of being buffeted around by what's happening in Ukraine, the supply chain issues that we're having trouble with in terms of getting enough supply that's coming out of, the lockdowns that are happening in China. The Federal Reserve cannot control supply. I mean, one of the things I keep reading about is how much airline tickets are going up, how many flights are struggling and those types of things. And one of the main things is getting pilots. Well, if they raise rates, that's not going to get more pilots, right? So these are the things that are going to be a little bit uncontrollable, but the Fed has seemed to be very focused on getting back down to 2%. And so the group that feels that we might hit a lower low than we hit in mid-June really feels like the Federal Reserve is going to have to raise rates even more than they say, and that they'll, in so doing, create this scenario where the economy really struggles and enough to really impact earnings, which will ultimately impact the stock market to the downside. And their arguments are plenty, actually, and I think this path is a little bit wider. For example, as you raise rates, oftentimes, globally, all of a sudden the U.S. is paying pretty decent rates on its treasuries. People start buying treasuries because we're a safe haven, and other countries are raising rates, kicking us into, a possible global recession. And so people look to the U.S. and they start funneling money to the U.S. and then we're raising rates some more. More money comes into the U.S. and what happens is the dollar goes higher and higher and higher. And so we're hitting some really good highs right now on the dollar, and the projections are that it could go a lot higher. That can take a big chunk out of these big companies because the S&P 500 sells 40% of its products internationally. So the more the dollar goes up, the more expensive their products get, the less they tend to sell, the more they can cut into kind of their profit earnings. And then, of course, around the world, the dollar is the major currency, and it causes all kinds of problems when the dollar gets really high. Emerging markets often have debt that's denominated in dollars, and so they're taking their currency, their whatever their currency is, converting it to dollars and paying off this debt. And that can be way more expensive as the dollar gets gets higher and higher versus their currency. And so you've got all of these different things that are happening that are kind of this outside arena that the market the people that are afraid the market's going to go lower. This is what they're afraid of. That the Federal Reserve is going to have to raise rates more, and that they're going to keep raising rates in order to try to bring down inflation, and in so doing, they're going to create this problem in the economy. So this is the battle. Right now, the group that is winning is the group that feels that the low was already established in June. The market is going up. We're getting through some resistance levels. We're about to hit another resistance level, a fairly big one, right now. We're getting there right now. So next week might be really important. Do we just fade off of that and come back down? Is this just one of those rallies that happened? I mean, one of the things you have to remember is that the motion of this market is a lot like what happened in 2000 and 2008. It's not this V recovery thing like we saw 220, it dropped direct down and right back up. Remember that in 2020, we ended up with the Fed lowering rates, buying bonds, all kinds of stimulus coming out from Congress. None of that is happening here. And so we're getting these rolling downturns. And I very specifically remember in 2008 thinking, wow, this is such a great run-up. We're going to end up with this, it's over, right? And then it wouldn't be over. And it really kind of wears you out on the downside. So that's what we got to watch out for here, because one of the reasons that we could be running up is just because if you look at the surveys, the hedge fund managers have less exposure to stock than they had since 2008, and they have more short interest than they had since 2008, which means that they're shorting the market and they're out of it on the long side. What happens when the market starts to come back up is they have to cover these shorts by buying back those stocks. So these fund managers who don't really want to have stock, and that's why they're shorting, are actually having to buy stock, and they're driving the price up and up and up. And we've gone through this kind of hole in the resistance that we see, and we're flying through that right now. So, we'll have to see how this plays out, because you can get a scenario where things get so good that the fund managers and hedge funds, they have to jump back in and start buying stocks, not just from a short covering standpoint, but buying stocks because they feel like, they're missing out. They are being compared to these indexes, but you're going to have a period of time where they're willing to wait, because we all can see what happened in 2000 with these fake runs. We can all see what happened in 2008 with these fake runs. But because this has been so strong, and because the market has broken through some resistance levels, in our portfolios, we have eliminated the inverse positions. We had roughly 5% overall of our portfolios in inverse position, and we took that out today, actually. We're still keeping our treasury bill position, which is quite large, and that came from stock sales that we did kind of end of June. And really, I think right now you just want to be very cautious and incremental in your changes that you're doing. I still want to have a parachute with these T-bill ETFs in case the market does, follow what I think is probably the wider path, which is to get to a new low. But we'll reduce those more and more if the market takes the narrow path and just keeps on blasting through all these resistance levels and keeps on going. I think being cautious here is wise with all the different signs that are happening. And so, that's what we're doing at this point in time. So that's what I see. Battle between these two groups. Those are the arguments that are being made for each one. It's very fascinating to see how this will play out. And the Federal Reserve is in the middle of all of this, and trying to figure out what they're doing is a big issue with what we're doing right now. And so it's very, very fascinating. So keep going with everything. We're still making money right now, just because we still have exposure to the stock market, so that's good. And we'll see how this plays out. Really, I think the next week or two will tell us a lot of what's going to happen also. So look forward to that.